Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte. And as we come into the final minutes of this trading day on this Friday, September 19th, I'm focusing on the 10-year yield. This is the futures market here, expiration in September. And many people were watching the news that came out when the Fed lowered the rates by 25 basis points as they were focused on the economic weakness, particularly in the jobs market. And the bond market here, especially on the 10-year yield, basically thumbed their nose at the Fed, and rates are on the rise. As you can see here, we have some bullish candles showing up as we approach this 20-period moving average. Now, as I mentioned, the Fed has been very vocal about their concerns of a sagging economy, but once they reduce the rates and continue to reduce rates, that's basically opening up the door to what the bond market is looking at, this ugly inflation possibility down the road. Now, going back to what we're talking about with the jobs market, I am not quite sure what happens behind closed doors at the Fed, but I'm sure they're factoring in the projected global job displacement due to AI. Now, this is a report that came out from the World Economic Forum, where globally they're anticipating 92 million jobs lost. Now, moving into more economic data, I want to show you something here that the U.S. freight shipments are absolutely collapsing. The cash freight index, which is a key measure of freight volumes, hit the lowest level since the financial crisis, basically showing the weakening demand for shipping and goods. And obviously that's not going to be good for the economy. Now, as we come into the final minutes here, I'll go back to the chart. We're down to about 18 seconds. I want to show you what's happening with DIA. And we're selling off right at the end. And I believe this is from profit taking. We had a pretty decent trading day today. And there we have it. The markets are officially closed. And so usually when you have a good trading day, the shorter term traders, even the day traders, are most likely going to be taking their profits. Now, looking at the daily chart on DIA, you can see we're reaching for the highs here. And if you look at the weekly candles, we still have increasing volume on the way up. So this uptrend does not look like it wants to give up anytime soon. However, if you look at the small caps in IWM, that's reached the resistance area right here today. And the intraday price action led the small caps much lower. Now, that's not unusual because you have a shift in more or less a sector rotation after the Fed lowered rates. You're going to have money going into tech. You're going to have money going into the S&P. Some people have run out of margin buying power, so most likely they're selling their small cap stocks to finance larger positions with optimism that prices will continue to go higher. If we look at the Qs, again talking about tech, you could see that we now have added fan lines here where the trend is still accelerating to the upside. Let me get a good zoom in here for you. This is the most extreme fan line in the sequence of fan lines. So if we get a breakout below that fan line, we're most likely going to move to the next fan line in the sequence, which really isn't a big deal, being that these fan lines are fairly close together. However, once we break below this fan line right here, we're most likely going to drop, which will bring us closer to this 20-period moving average looking forward. So that's QQQ. Looking at the spiders, we do have another high here. But what I find most interesting on the S&P is that while we squeaked out a very small increase today, just under 0.5%, look at the volume drop here. And the volume drop has caused the CCI to form a sell signal down there. You see that? Let me magnify that. You can see the blue line is the CCI itself, and now it's crossed below the red line, which is the plus 100 mark. So we're coming in today with a market close of 97.1565, and so that's showing a little bit of weakness there. And then, of course, when you look at the VIX as compared to the S&P, which is for the most part inversely related to the S&P 500, interestingly enough, we had a drop in the S&P, but we also had a drop in the VIX. That is not normal. That's not what we usually see. However, the VIX did manage to close over that 20-period moving average, and we have some mixed signals. You can see that the stochastic down there is pivoting lower, while the CCI, which is the more sensitive of the two, is pivoting higher and coming very close to that momentum line, which is the 0 line. Now, once we cross that, most of the time you'll see a 2 to 4 day move in the direction of the cross. So next week is going to be interesting, being that this was expiration Friday for the option markets. We generally see an increase in volatility in the week that follows options expiration. Now, going back to what we see here in the trucking, with regard to freight, you're going to see stocks like JB Hunt, which is ticker symbol JBHT. They're going to be under pressure as well. And so I've said this before, but I like repeating because repetition is the best teacher. If you take a look at a 10-year weekly of JB Hunt, and you could even look at the Dow Jones Transports, which are mainly going to mirror what we're seeing here in JB Hunt, the trucking industry and products that move across our highways is basically the lifeblood that runs through the veins, also known as the highways of our country. So when shipping suffers, then that's telling us, it's a leading indicator that product is not moving, that the demand for those same products are dropping, and that's an absolute weakness. Now, if you go and look at what I think is the most overlooked indicator that came up this week, this is the Conference Board's leading economic indicators. This is the LEI, as it's referred to. This had a very big drop. You could see here that we came in with a forecast yesterday of minus 0.2%, but this was a shocker because the leading economic indicators are pointing most definitely in a downward direction here. And so we went from a positive 0.1% to now a minus 0.5%. And so if you're looking for this information or you want to track it and maybe even read some of the reports that are out there, this is the forexfactory.com. I have it bookmarked. I look at it almost every day to see what's coming out with regard to economic indications throughout the world, not just with the U.S. And you can see here they give a good explanation of what that is all about. It gives you the notes and what the index is measuring. It gives you the effect of the market. So in other words, if it came in lower than forecast, that's not going to be good for the currency, meaning the market. And so this is a great bookmark to keep, and I encourage everyone to do that as well. Now, I want to talk a little bit about what's happening in silver. If you look at the silver futures market, we broke out over 40, and this is a big deal because now we have a breakout with increasing volume on the way up. So I have a forecast on silver for $50 by the end of this year. I know I was sticking my neck out when I wrote about that in the Zero Hedge articles that I put out, but I do believe that we are on our way to 50, at least to test that. Whether we break out over 50 or not, we'll have to see. But if you look at the monthly chart on this one, this is a vertical trend that is very similar to what we're seeing in AI. The big difference between AI and silver is that we have major economies still accumulating silver and buying into the physical metals. And here's a report showing what's happening in India. Where this is showing over the last 3 years, we're seeing record levels of silver being accumulated by India. We know that's happening in China with both silver and gold. And if the silver stackers and the long bullish silver traders get their way, then either by the end of this month or mid next month, we're going to see the Department of Interior make an announcement to finalize the list on what they're putting on the critical minerals list, of which silver was mentioned in the draft. We had copper also mentioned, as well as potash. So keep an eye on the stocks that are related to those commodities. And I have a feeling that we're going to see a big spike, more than, and I believe much more than, a knee-jerk reaction to that news. And so with the silver markets raging forward, you have to understand something, that 60% of our option trades are positioned with a positive delta or bullish bias, while 100% of our equity trades have been bullish on the buy side. And we have a mix of, I would say, 60-40 mix, with 60% being bullish on the directional option trades that we've placed over time. And so that brings me to the trade of the week, which is absolutely related to the silver market, which is Majestic Silver. Now, let me go over the details and then I'll back it up and show you how this trade went down, how we started the trade, what signals we were looking to get into a long position, and what happened afterwards. Now, please remember, this is a report card that I use for educational purposes. This is not a recommendation or financial advice or anything like that. I must state that for the YouTube channel so that we don't get flagged in any way. So please understand that I'm showing you examples of what I've done, what I'm doing, and what I will most likely do in the future. And I also project that out onto X, where I post a lot of silver charts, letting people what I'm doing in that market as well. All right, so on September 10th, a publication went out highlighting Majestic Silver, where we went into the January $10 calls. Now, if you're not an option trader, understand that a call is a contract between a buyer and a seller. And when you buy a call contract, you're basically buying the right to buy the underlying stock at a certain price. So if the stock goes up after you buy a call, like it has here, the price of that option will also go up. So 2 days later, after these calls were purchased, they rallied all the way up to 190. So you had an 80-cent profit on a $1.10 trade. Now, each option represents 100 shares. So while it's priced in dollars per share, that option contract cost $110. Or I should say, every option contract you buy would have cost you $110. So if you sell it for $1.90, you're making 80 cents or $80 per option contract, and that would have given you a 72.7% return. Now, if we look at today's chart of Majestic Silver, we have this massive green candle on volume that was just about twice what we saw yesterday. And while I was expecting a little bit of a pullback here, First Majestic did just that. It pulled back to the former resistance, which is now role reversal support. It pulled back perfectly to that, created a hammer candle, and now the stock is pivoting back up. So if you're in this market, understand that you must pay attention to the technical signals if you want to do your best to manage risk in a position like this. So let's give you an example. Let's say you sold out of those calls, you took your profit, and let's say yesterday you see that hammer candle right there and you want to buy back into that position. You have to use this role reversal support level as your guide to manage the risk. So in other words, if it closes below that support level and at the same time closes below that 20-period moving average, which is the blue line, that would be your signal to get out. And it's not me telling you that. That would be the charts telling you that. Manage risk, wait for the next buy signal before you get in, and save your buying power. And that's exactly how we trade. Now, going back to what we did on the 10th, you have to understand that right here on that green candle was the day the publication went out. And if you look at that, these two candles right here create what's known as a bullish Harami. A bullish Harami is a small body green candle that falls within the body of the red candle. And you can see that the volume was dropping on the way down here. The bullish Harami shows up. What happens the very next day? We get this big green candle. And here's the day that those options were trading at 190. Now, look what happened afterwards. Now, when I talk to the members, I'm talking about that shooting star. I'm talking about this being a half signal. And then I'm absolutely talking about this bearish engulfing candle. And so a bearish engulfing candle is going to be bearish 80% of the time. If you want to learn more about how these candle patterns work out, make sure you plug into our Technical Tuesday educational snippets. I'll call it a snippet because they're only about 8 to 12 minutes long. So you're getting your technical analysis vitamin each and every Tuesday. And that's compliments of StickyTrades, of course. Now, if you follow the Technical Tuesday videos, you're going to learn something new each and every week. And you have the ability to ask me a question on the comments field of that video, or you can leave some comments to let us know what you think. Now, taking a look at how AG traded today, right from the opening, it opened pretty much right on the low. You see down here as I magnify that. And it did not look back. And unlike what we were looking at in the diamonds, where we saw a little bit of profit taking towards the end of the day, we did not see that in AG. In fact, we saw a rally in the last 15 minutes of the day where we had very close to a bullish engulfing here, another bullish engulfing candle here, and then it closed just pennies off of the high for the day. Now, again, if you are going to be trading silver or any other equity or option, you must make sure that you're managing risk. That's the thing that I could say with confidence, that there's one guarantee that I actually can give you, and that is if you allow the market to take money from you, guess what? It will. So the whole idea of risk management is being able to limit the loss when, not if, the market goes against you, and so that you preserve your buying power and you'll have enough to get into the next trade and not have to worry about you losing, 20, 30, 40, or 50% of your account, which in turn would be labeled as a catastrophic loss. So that is our weekly market report. Stay tuned. Next Wednesday, we're going to have another guest appearance from Tim Lindsay to talk about mortgage rates and what he's seeing on his end. He'll be giving you some reports on what's happening with mortgage rates. If you're a home buyer or you know someone who's buying a house, you might want to plug into that one in particular, because Tim is going to give us some golden nuggets to think about with regard to investing or even buying a home in this type of a market. So that is it, folks. You have a good rest of the weekend. We'll talk to you next time. So long.
In a world of endless data, where every second counts, introducing Nod Live, your professional compass in the chaos of the stock market. Nod Live cuts through the noise. Stay ahead with Nod Live.